Hi everyone, a very good evening and welcome once again to yet another session under our Edelweiss Konnect Klassroom initiative. And today the topic that we have chosen is called 6 factors to consider while investing in mutual funds. I'm sure we all invest in mutual funds predominantly, or at least sporadically, and we have invested in mutual fund. Let me just put it blandly that we've all invested in mutual funds, right? And I'm sure we all would perhaps agree with this part that choosing the right scheme is the most difficult aspect of the investment part. So I want to invest. Mutual funds is a product which I feel is the right investment vehicle. This decision becomes easy. I want to invest in equity. That also somewhere, via the mutual fund route, that also somewhere becomes easy. But which scheme to choose, I'm sure, is the decision which does play on our minds to a great extent. And that is why, to solve this on where should I invest, in which scheme should I invest, I either do my own research, I talk to my friends, I look at my past experience, and basis that I choose, or I may be talking to some distribution and partner, some advisor, and basis whatever I understand and agree, with whatever I'm reading or I'm hearing, I may decide to choose a scheme. But one thing which keeps on hovering in my mind is there any logical way or a logical step or logical factors which I can consider to choose a scheme, right? We all rely on a lot of factors, right? And it could be basis whatever logic I have developed through my own experience, or through my readings, or through my discussions, and basis that I will choose whatever I think is going to be the scheme which is going to be the best performing given the current market situation and my readings around it. But will that always be the best performing scheme, or will that always turn out to be the best performing scheme? That's a question which is $1 million question, right? And on a lot of occasions, it could be that I may think that maybe not this. I should have invested in some other scheme. So what I'm going to do today, and during the course of this session, in the next about 25-30 odd minutes, I'm going to share with you what are those 6 factors which you must consider while investing in mutual funds. As usual, please, post your questions, if any, in the chat box, and I will be more than happy to respond to each and every one of them towards the end of the session. Okay, so on that note, let's begin. And the first factor that we should all consider is we should know about what is the investment objective and what is the investment style that has been adopted by the scheme. Every scheme has an investment objective, right? I mean, if you're talking of an equity scheme, the objective would have words like achieve capital appreciation, which should mean that during the course of the investment in this scheme, the endeavor of the fund manager would be to have some level of capital appreciation. That is a growth in capital, right? In a fixed income, you could have words like capital preservation. In a sector fund, you could have the objective stating that the scheme is going to invest in companies in the chosen sector to achieve capital appreciation or growth and things like this. So this gives you a very, very clear idea, and hence it becomes very, very important for us to know what is the objective of the scheme, because that will give me a very clear idea what is the scheme striving to achieve through the investments in this scheme. So then I need to then personally check whether this is an objective which works for my investment needs, for my investment goals, and does it work for my risk profile. So that's investment objective. Similarly, there is always going to be an investment style, and every scheme adopts a certain style. It could be basis market capitalization. So there are schemes categorized as large cap, there are schemes categorized as mid cap, there are schemes categorized as small cap or even micro cap today. Then there are schemes even categorized as flexi cap or multi cap. So basis market capitalization, you could have an investment style. So a large cap would mean that I am going to invest in the top 100 companies, and top 100 companies obviously would mean that in terms of volatility of investment on the equity markets, the volatility is a little better managed in comparison to the mid cap and the small cap universe, because of the companies being a little more the companies being a little larger and a little more stable. So in terms of market capitalization, I could do that, or it could be also according to fund management style. I could be investing in growth companies, value companies, momentum driven companies. We did a program on what are those investment styles, and that's available on our YouTube channel. If you want to know more about what are the various styles that a fund management team can adopt, then I'd advise that please have a look at that, and that will help you. So all of this information about what is the investment objective, what is the investment style, is very, very readily available, on any asset management or mutual fund company's website, or even in the scheme information documents. We must go through these documents so that we know what exactly are we getting into when we are investing. So this is the first factor: investment objective and investment style. Similarly, you need to also look at what is the role of the fund. Now, when I talk of role of the fund, what I mean is you need to consider, prior to scheme selection, what is the role that the fund or the scheme is going to play to keep your portfolio clean and well balanced. Some schemes that you will invest into will be a little more aggressive in terms of their bets, and obviously that would mean that I'm investing in these schemes because these aggressive bets will, over my investment period, have a higher probability of spiking up some returns for me. Some schemes may be looking at stability and consistency, and basis that you have made your investments. It is very, very important for all of us as investors to understand the reason of investment into a particular scheme, and what role is this scheme going to play in my investment journey and my investment expectations. If I don't have an answer to this question, then very honestly, it may be time for you to rethink whether the schemes you have chosen are adequately prepared to generate the returns that you are expecting. Right. So there, you need to think about what is the role that a scheme is going to play, and how is it that this scheme is going to generate the return, and why is it that you want to choose this scheme, and how will this scheme help in your overall, investment objective. So just like a scheme has an investment objective, we also should need to have, what is my investment objective? What is it that I am endeavoring to achieve by making this investment? Because if I don't have that, then, like I've spoken in some of my previous sessions also, then there may not be any reason for me to invest. Then there may not be any expectation also from what I want in a very, very quantifiable manner. So role of fund and role of this investment scheme is the second factor which we all should consider. And I think it's very, very important for us to understand, how is this scheme going to help me? How is this investment going to help me in achieving my investment objective? Second factor. The third factor that we all should consider is, what is your investment horizon? For how long do you want to invest? So if you are going to invest for the long term, then we all know that equity is perhaps the best asset class, and it has a history. It has a demonstrated history of generating returns over the long period of time. If my investment is only for the short term, then equity may not be your best friend in that case. Then you may look at a lot of fixed income investment options available and choose from those, right? And so how long am I going to invest decides on what is my percentage of investment across various asset classes. And basis this, I will then decide of, you know, uh, what should I invest in and where should I invest in. Of course, with around with how long, you also need to look at what is it that you're planning to achieve. Are you looking at generating substantial returns on investment? So obviously then, equity would be the preferred asset class. If you're looking at protecting your capital to a great extent, then even over a long period of time, you may still be happier with a fixed income heavy investment basket. So your time, the time that you stay invested into should decide on your asset class and your asset allocation and your investments across the asset classes preferred. Also very, very important to remember is, as you go closer towards maturity or closer towards when you think that you would want to redeem, please don't forget the rule to rebalance your investments in order to ensure that you're able to curb and manage the volatility better towards the latter end of your investment period. So third factor which we all should definitely keep in mind whenever we are investing, and we should definitely look at before making an investment decision, is what is my investment time horizon. Because this time horizon then lets me know of what is it and what percentage can I invest in what asset class. So far we've done three factors. The first factor that we spoke about was about investment style and investment objectives. We need to understand what is the objective of the scheme and what is the investment style that the scheme is adopting. The second factor that we spoke about is about the role that this investment is going to play in achieving my investment objective. So that's the second one. And the third one is, for how long am I going to be invested? Because that will decide on what is the asset class that I should be investing into to generate the returns that I expect from my investment. That's the third one. Moving on to the fourth factor is, one thing that we should look at is, what's the track record or the performance of the investment, right? And there are various ways in which you do this, right? Is it a consistently performing scheme? So when I look at, the returns in comparison to, let's say, the benchmark or the category average, how consistently has this scheme performed over the prescribed format of 1 year, 3 year, 5 year, as well as since inception. It is not something which you should look for a short period of time. Let's say the scheme has done exceptionally well and been very consistent over the last 9 months, but has not been that consistent over the long period of times. But if you're looking at consistency, then you need to look at how has it performed over a long period of time. So consistency of returns is something which you should look at. Second is also, a lot of investors look at whether this has outperformed its benchmark. The idea of the idea of investing in any active scheme is because you think that this scheme will perform better than the underlying benchmark, right? For a lot of investors, and hence it becomes very, very important for these investors to look at whether the scheme has been an outperformer or not. Okay, but yes, I mean, just because it has been an outperformer in the past, would it continue to be an outperformer in the future? Is something which you need to look at. And hence, I mean, what you should be very, very sure about is if there is no guarantee that past outperformance will also lead to future outperformance, and hence there are other factors like volatility and who's the fund manager, and perhaps even size to a certain extent, which a lot of people look at before making the investment decision. Let's look at these factors also in terms of tracking performance and performance record of any investment. So when you talk of volatility, for example, the volatility of any scheme should be in sync with what the scheme is trying to achieve, which is stated in its investment objective, right? So a high risk, high return, potential high return rather, is, if you're looking at that kind of investment, then you will expect a higher degree of volatility. But if I don't want a higher degree of risk, then what I also am sure of is I do not want an excess degree of volatility in my investment, because I'm okay with lesser in terms of returns in comparison to the higher return products. Then I also expect a little more peace or little less stress and definitely lot less volatility to manage my investment. So how do you check volatility? There are ratios, for example, beta or trenor. These give you an idea about how you can about the volatility in terms of the scheme and the reward to volatility. So you must look at these and basis these make an investment. We have a program on risk also, in on our YouTube link, and that may also be a good idea for you to look at if you're just starting out in your investment journey, or you want to understand how can you manage and measure the investment risk that you're taking. Similarly, fund manager. A fund manager plays a very, very important role in my investment journey, right? Because he's the one who's managing my money. It is his decision of where he wants to invest and how he wants to manage this money. Obviously, he has a strategy which he publishes, and there is an idea about what he's going to do. But I need to have faith in the person. So, what's his track record? For how long has he been managing schemes? What's his strategy? What are his biases? What is his reputation? All of this matters to me as an investor, because if he is managing my money or she is managing my money, then I need to be able to trust this person with my money. And how will I build this trust? I will be able to build this trust by looking at his or her track record, his reputation, what are his biases, and are there any biases, or what's the strategy that he or she is deploying in investment, and how comfortable am I, or in sync am I with this strategy that he or she is wanting to play in the market. So what's the fund manager going to do also becomes important. Last factor which a lot of people talk about is also called size of fund, right? I mean, and the size, now this is something which is very, very debatable. Like, for example, I mean, everyone talks of an optimal size, but nobody's able to point a figure and say this is the optimal size, right? Because I mean, what everyone will agree upon is if it's a large fund, then obviously it means that I would have to over diversify and take too many risks and invest in too many securities, because I have that kind of money and I need to spread myself that much thinner. But if it's a small fund, then that means because I don't have a lot of money, then I'm investing in, maybe I'm little curved for liquidity. That could also be a problem, right? Because if then you want to redeem, and then I don't have the adequate liquidity to honor your redemption, then obviously, it's going to be a problem for both of us. So size of fund, although a lot of people talk, there is no optimal number which anyone has been able to ever come up with, that this is the best number and best size for any scheme to have. But there is size, of course, and that also means that I'm not saying that whenever there are new schemes that you should not invest. New schemes mean that there's a new strategy that the scheme will deploy. There's an opportunity that the asset management mutual fund company and the fund manager is seeing in deploying money in this basic scheme objective that they have stated. It would still be a good idea to enter right at the start and be there. Although at that point in time, we don't know how much of a size will that scheme, garner, and everything else. But then you look at other factors like fund management, and the asset management company or the mutual fund company that is getting this scheme, and what are they doing, and how have they performed in other aspects, in order to decide. So size of the fund, although a lot of people talk about, nobody will be ever nobody will ever be able to give you an optimal number of this is that number that should be that that should be the optimal size number. So that's not available. Okay, but these are factors which we should all look at when we're looking at performance or track record. What you should see is the size growing on a regular basis or no. That means that more and more people are trusting the scheme, more and more people are joining hands with you in staying invested in the scheme. So that may be a better barometer to look at. Is the scheme growing over a period of time or not? Because if people are trusting it, then they will invest. So that's how you can look at, in terms of size. Fund expenses, one factor which the fifth factor which people talk about, and something which a lot of people consider while making an investment decision, is what is my fund expenses. So total expense ratio, or TER, is a number which gets published, and quite simply, I mean, if I look at how you should be looking at this number, then lower the TER, then better the potential return on your investment is how people look at it. But again, just how size, I would also say that just don't focus on low TER. There could be situations, there could be schemes which have a lower expense ratio, but their performance also in comparison to their other peer set may not be that attractive. So in that sense, even though the fund is charging me less, I'm also getting less in terms of the peer set. So what is important to see is, in comparison, if you're looking at similar performing schemes where the returns are almost similar, then you would obviously want to go with the lower one. To be very honest, I mean, if I were to just put, how do you look at it? So lower TR works more. Lower TR should something be looked at more in terms of index schemes or passive schemes, because over there clearly you are going to meet the bench. You're going to get nothing but benchmark returns which are comparable. So a lower TR means that I will probably get that 0.1, 0.2 basis extra. But in an active scheme, just looking at lower TER should not be the case. But this is a factor which a lot of investors consider, and hence I think it is something which I should be speaking to you about. How is this total? What is this total expense ratio? Basically, it is all fund expenses incurred. So it will be your fund management expenses, your administration expenses, your brokerage charges, marketing expense, sales expense, commissions being paid, everything that goes into managing a scheme is charged to the scheme, and it is part of your total expense ratio. SEBI has calibrated of how much maximum can a scheme charge, and all asset management companies, mutual fund companies are mandated to follow it and are following it. So in that sense, it is a fairly regulated number. It's not something which can be decided by the mutual fund company on its own. It is something which SEBI decides and publishes of how much maximum can I charge, and I need to not exceed the maximum limits prescribed. So that's on fund management expenses. The last factor that people talk about is what is going to be my taxation on the capital gains that I get, right? What is the taxation? So in taxation, it's become fairly simple. I mean, if you're invested into what is known as equity oriented schemes, or other than equity oriented schemes, are those schemes in which investments into domestic equity is less than 35%. Okay. So now, earlier there were equity schemes, fixed income schemes, and other schemes. But now, in the last, in the last budget session, or rather little post budget, there's been an amendment which says equity oriented schemes and other schemes. Other schemes are schemes which have an exposure into domestic equity lesser than 35%. Okay, so in equity schemes, if you have invested for a period of less than 1 year, that is then, and you're redeeming, then and you made money, so you are liable to pay what is known as short-term capital gains, and this is charged at 15%. If you're invested over 1 year period and you're redeeming your investments, then you are liable to pay something known as long-term capital gains on the gains that you have made. That is at 10%, but this 10% is over the 1 lakh rupees of capital gain uh, that you would have, that you may have got in the financial year. Okay, so that's how equity and all other schemes, whether it's short term or long term, you get charged on your tax slab. Okay, so these are your 6 factors which you need to consider. To summarize, you need to understand and know the investment objective and the investment style adapted into the scheme. You need to decipher what is the role that this scheme is going to play in your investment journey. Second one. The third one is you need to delve into what is your investment time horizon and choose investment asset classes basis that time horizon. You need to check on the performance and track record of the schemes that you're investing into. Even if you have already invested into schemes, it makes a lot more sense to keep on checking into these, so that you know that they are on track of, what were your expectations. You need to keep a track on what's the total expense being charged into the scheme. And you need to have an idea on what's the tax implication that you will be liable to pay whenever you redeem. These are the 6 factors which you must look at before investing into any scheme. More than happy to take your queries and questions now. Okay, there's a question that, I'm doing an SIP in various schemes and my time horizon is for the next 10 or 20 to 12 years. So I am already investing from last 5-6 years. Should I continue considering? Yes, I mean, since you've invested across, and I'm sure you would have as analyzed on what your expectations in terms of returns are, and for how long are you going to stay invested. That's already mentioned, and basis that chosen your investment scheme. So so you could continue because you're still about 10-12 years away, from the time that you want to realize the investment made. And in SIP, because you're investing smaller investments over a long period of time, staying longer helps, right? So in our previous session, we did a session on SIP. That's also available on our YouTube channel, and maybe that will also give you some other benefits that you should look at in terms of SIP. But in an SIP, because staying longer pays off better than not staying on the longer end. So name of YouTube channel. So we are there on so Edelweiss Mutual Fund is available on YouTube, and over there we have a tab called Edelweiss Konnect Klassroom, which is a sub tab on the Edelweiss Mutual Fund YouTube channel. So please have a look at that, and all our videos are available over there. Okay, anyone else? Any other questions, queries? I'll be more than happy to respond, please. Okay, so there's a question. Is there any advantage of NFO versus existing fund based on your return expectation? So return expectation is one part of the story, but when an NFO comes, the advantage which an NFO brings is, it is looking at current market situation, basis current market situation, creating a portfolio for the next few years, right? And basis that, there will be a performance that the scheme will give. So that's one. So if I think that I want to invest in a scheme, now this NFO scheme doesn't have any baggage. It starts at scratch. So in that sense, it may work in my favor. But at the same time, that scheme doesn't have a track record. So and another case, if there is a scheme which has already performed, it is already performing, and the strategy for future performance also seems good, then it's a choice. But an NFO, because of the clean slate, a lot of people also look at NFOs as a great start for investments. Anyone else? Any other queries, questions? Okay, we'll just wait for a minute more. If there are any other queries, questions, I'll be more than happy to take that. Okay, I guess no queries and questions, no further queries and questions. So on that note, once again, thank you very much for your time and patience. And we'll connect again in one of our sessions in the coming month. Till then, do take care of yourselves. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.